first unit in economics, which is money, savings and investments. In the last class, we have already seen about what is economics, why do we study economics, understanding economics, introduction part. Finally, we have discussed about evolution of money. Synopsis of the lesson. In this session, we are going to see the following topics. The first one is value of money, next nature of money, then functions of money, then savings in banks and investments. Finally, we have black money. Students, do you know who invented the symbol for Indian currency? Symbol of rupee. The Indian rupee symbol designed by Mr. Uday Kumar, Viluppuram district, Tamil Nadu. It was approved by the Government of India on 15th July 2010. So, the Indian rupee symbol was designed by Mr. Uday Kumar. He belongs to Viluppuram district, Tamil Nadu. It was approved by the Government of India on 15th July 2010. Here we can see the picture of Mr. Uday Kumar. Next, we are going to learn about value of money. Value of money is meant the purchasing power of money over goods and services in a country. Thus, it is related to the price level of goods and services. When you will know the value of money? When you go to a shop and you buy a product. So, depends on the price level, value of money is determined. The value of money is of two types. The first one is internal value of money and the second one is external value of money. The first type is that internal value of money. The internal value of money refers to the purchasing power of money over domestic goods and services. So here, internal means purchasing within the country. The second one is external value of money. The external value of money refers to the purchasing power of money over foreign goods and services. So here, external means outside the country. In other words, purchasing the foreign goods. Next, we are going to learn about nature of money. According to Sitoksky, he is an economist. According to him, money is a difficult concept to define, partly because it fulfills not one but three functions. So, he said, money is a difficult concept to define. It doesn't perform one function, whereas it performs three functions like a unit of account, a medium of exchange, and a store of value. Here, a unit of account means using money we can buy a property. A medium of exchange means by giving the money you can buy the products. So, it acts as a medium of exchange. A store of value means that is we can save the money for our future expenses. According to Sir John Hicks, money is defined by its functions. Anything is money which is used as money. Money is what money does. So according to Sir John Hicks, money can be defined based on the functions or the role it has in the economy. Next, we are going to learn about functions of money. Functions of money are classified into three. The first one is primary or main functions. Next, secondary functions. The third one is contingent functions. Functions of money are classified into three, like primary, secondary, and contingent. Under primary, it acts as a medium of exchange, a measure of value. Secondary is store of value, deferred payments, transfer of value. Contingent functions are basis of credit, income distribution, equalize marginal utility. Next, let's see about primary or main functions. The important functions of money performed in very economy are classified under main functions. The first one is medium of exchange or means of payment. Money is used to buy the goods and services. So, medium of exchange means the fundamental role of money is to serve as a medium of exchange. A consumer can purchase any commodity or service with help of money. The second one is measure of value. All the values are expressed in terms of money. It is easier to determine the rate of exchange between various type of goods and services. So, measure of value means the value of all goods and services is expressed in terms of money. It helps to compare value of all commodities. Every country has a standard money or a monetary unit in terms of which values are expressed and measured, which is known as currency, such as dollars, pounds, etc. Next, we are going to learn about secondary functions. The three important of secondary functions are: the first one is standard of deferred payment. The second one is store of value or store of purchasing power. The third one is transfer of value or transfer of purchasing power. Now, let's see one by one in detail. The first one is standard of deferred payment. Money helps the future payments too. A borrower borrowing today places himself under an obligation to pay a specified sum of money on some specified future date. So, standard of deferred payments means future payments are termed as deferred payments. Deferred payments are possible only because of money. Money makes possible the credit transactions to happen. Money acts as a standard of deferred payments. So, as a whole, money is a standard of deferred payments, and money is useful in the purchasing goods on credit as it is easy to borrow and lend. The second function is store of value or store of purchasing power. Savings were discouraged under barter system as some commodities are perishable. Here, perishable means destroy, decay, or spoiled. The introduction of money has helped to save it for future as it is not perishable. So, perishable means which can be destroyed easily. As we have seen earlier, the fourth drawback of barter system is difficulties of storing wealth. I have explained using fruits and vegetables. When fruits and vegetables are exchanged, what happens? We cannot store it for much longer period of time because both will get spoiled. So, that is the meaning of perishable. Whereas After the invention of money, that is, after the introduction of money, it helps in the savings. So, we can save the money for future because money is not perishable. So, money will not get spoiled. So, we can save it for the future. The third function is transfer of value or transfer of purchasing power. Money makes the exchange of goods to distant places as well as abroad possible. It was therefore felt necessary to transfer purchasing power from one place to another. So, transfer of values means today, with the extension of trade among various countries and organizations, it becomes necessary to transfer purchasing power from one place to another. Next, we are going to learn about contingent functions. Under this, we have basis of credit. In our last session, I have told what is the meaning of credit money or bank money, right? So, example is check. Check acts as equal importance to that of money. Here we can see the picture of check. Next one is increase productivity of capital. So, which means the money increase the production process in a country. Third one is measurement and distribution of national income. We can measure the national income of a country. So, national income means what the GDP, that is gross domestic product. So, the GDP depends upon the production of a country, whereas the production depends upon the capital. Students, do you know what is mean by inflation and deflation? Inflation refers to the prices are rising, the value of money will fall. Deflation refers to the prices are falling, the value of money will rise. Next, we are going to learn about savings in banks and investments. First, we are going to learn about savings. Savings are defined as the part of consumers' disposable income which is not used for current consumption, rather kept aside for future use. There are several ways through which a person can save money. The banking facilitates. Here, facilitates means helps or simplifies. So, the bank helps or simplifies saving money through various forms of accounts. There are several ways to save money like student savings account, savings deposits, current account deposit and fixed deposits. Now, let's see one by one in detail. First one is student savings account. There are savings accounts some banks offer specifically for young people enrolled in high school or college. The main features of these accounts is to maintain zero balance. So, zero balance means that you don't have to pay any penalties for not maintaining a minimum balance. The second one is savings deposits. Savings deposits are opened by customers to save the part of their current income. The customers can withdraw their money from their accounts when they require it. The bank also gives a small amount of interest to the money in the saving deposits. Third one is current account deposit. Current accounts are generally opened by business firms, traders and public authorities. The current accounts help in frequent banking transactions as they are repayable on demand. The fourth one is fixed deposits. Fixed deposits accounts are meant for investors who want their principal to be safe and yield them fixed yields. The fixed deposits are also called as term deposit as normally they are fixed for specified period. That means so they will deposit a particular amount for a particular period of time. So that is called fixed deposits. Next, we are going to learn about benefits of savings. The first benefit is that you will be financially independent sooner. When you start saving means there is no need to depend on others for money. The next benefit is you would not have to worry any foreseen expenses, which means if there is any emergency requirement means so there is no need of worries because you already saved some amount, so you can withdraw it whenever it is necessary. The third benefit is that in future you will have financial backup in place if you lose your job. Fourth benefit is you will be prepared if your circumstances change. Next benefit is that you will be more comfortable in retirement. The final benefit is that save today for better tomorrow. So next we are going to learn about intensity to save among the students. Here intensity means strength to save among the students. Teach them about taxes and accounting. Involve them in grown-up money decisions. Encourage them to apply for scholarship. Then help them budget and apply for student loans. Then finally teach them personal savings. Next we are going to learn about investments. The process of investing something is known as an investment. It could be anything, that is money, time, efforts or other resources that you exchange to earn returns in future. So investment can be made in different investment vehicles like stock, bonds, mutual funds, insurance, annuities, deposit account or any other securities or assets. An investment always comes with risks of losing money, but it is also true that you can reap more money with the same investment vehicle. Here reap means gain or earn. So an investment always comes with risks of losing money, but it also true that you can gain or earn more money with the same investment vehicle. It also a productive nature that helps in the economic growth of the country. Next, we are going to learn about comparison of savings and investments. Savings represent that part of the person's income which is not used for consumption, whereas investment refers to the process of investing funds in capital asset with a view to generate returns. Example for saving is if a person is earning a monthly income, so apart from his consumption he will save a part of his income, so that is called savings, that is for future use. Whereas if a person is investing in some mutual funds or in insurance in return to get a huge amount in return, that is called investment. Now let's see purpose. Savings are made to fulfill short-term or urgent requirements, whereas investment is made to provide returns and help in capital formation. So in investment, we are investing to get a high returns. The risk is low or negligible. Here negligible means small. So the risk is low or small in savings because you are depositing in your account. When there is an emergency, you can withdraw it. Whereas in investment, the risk is very high because sometimes the shares may go down or there are many fraudulent cases we can see nowadays. Next, let's see returns. In savings, no or less, whereas in investments, comparatively high. If you deposit a specified amount in a bank, you will get only less interest, whereas when compared to the savings, in investment, you will get high returns. Now let's see liquidity. In savings, highly liquid, whereas in investments, less liquid. Savings are highly liquid. You can get the cash on time. In other words, we can get the cash as soon as possible, whereas less liquid means after the completion of specified term only, you can get the returns. Next, we are going to learn about black money. Black money is a form of unaccountable money. Black money is mostly created by business people. They do not show actual income earned in their economic activities. They show only a part of income earned for the purpose of tax evasion. First, we have to know what is meant by tax evasion. Tax evasion is an illegal activity in which a person or entity, here entity means organization or institution, deliberately avoids paying a true tax liability. Those caught evading taxes are generally subject to criminal charges and substantial penalties. So, black money is any money on which it is not paid to the government. Black money is money earned through any illegal activity controlled by country regulations. Then, black money proceeds are usually received in cash from underground economic activity and as such are not taxed. The black money is accumulated. Here accumulated means collected. So the black money is collected by the criminals, smugglers, hoarders, tax evaders and other anti-social elements of the society. In India, black money is funds earned in the black market on which income and other taxes have not been paid. The total amount of black money deposited in foreign banks by Indians is unknown. The root cause for the increasing rate of black money in the country is the lack of strict punishments for the offenders. Next, we are going to learn about effects of black money on economy. The first one is dual economy. Dual economy in terms of developed sector on one side, underdeveloped sector on the other side. So, because of black money, we have to economy. The person who show lot of false accounts will come under developed sector, whereas the other one is underdeveloped sector. The next effect is that tax evasion, thereby loss of revenue to government. So what is mean by tax evasion? Tax evasion is an illegal activity in which a person or entity, here entity means organization, deliberately avoids paying a true tax liability. So, because of the false accounts which they are producing, so there is a loss to the government, that is tax evasion. The next one is undermining equity. So because of the black money, there is no equal economic growth in the society. Next one is widening gap between the rich and poor. Next, lavish consumption spending. Here, lavish means very luxurious or very rich spending. The next one is distortion of production pattern. So, because of the black money, there will be a slight distraction in the production sectors. The next one is distribution of scarce resource. Here, scarce means rare or uncommon resource. So, distribution of rare or uncommon resource. The next one is effects on production, which means the production process will be affected because of black money. Students, do you know what is mean by demonetization? In India, on 8th October 2016, the government of India announced demonetization of all 500 and 1000 bank notes against black money. So, demonetization means withdrawal of all 500 and 1000 bank notes against black money. Now let's see recent steps against black money. Under pressure from India and other countries, Switzerland has made key changes in its local laws governing assist foreign allegedly stashed in Swiss banks. Here, allegedly means confirmed or declared. Stashed means hidden. So the money which were hidden in the Swiss bank in Switzerland. The next step is that special investigation team was appointed by government on the directions of Supreme Court on black money. Next step is that demonetization. We have already seen about the term demonetization. Demonetization means withdrawal. So the government of India announced demonetization, which means withdrawal of all 500 and 1000 bank notes against black money. Finally, we are going to see some legislative framework in India against to black money. The first one is Prevention of Money Laundering Act was passed in the year 2002. The second one is Lokpal and Lokayukta Act. The third one is Prevention of Corruption Act was passed in the year 1988. The next one is the Undisclosed Foreign Income and Asset Bill. Imposition of Tax was passed in the year 2015. The next one is Benami Transactions Prohibition Act was passed in the year 1988, which was amended. Here amended means revised in the year 2016. The next one is the Real Estate Regulation and Development Act was passed in the year 2016. I have enclosed the classwork instructions in the PDF. Kindly refer it. So now we have reached the end of this session. Thank you.